Staying on top of things that might shake up your finances is super important, and today we're going deep on a topic that could do just that. We're having this conversation thanks to the folks over at My Tax Accountant, a really well-respected UK accounting firm. They wanted to get the word out about these big changes to UK tax rules hitting this April, the 6th to be exact, that'll affect non-domiciled individuals, non-doms, and how they're taxed on any income they make from overseas.
Yep, spot on. You see, for ages, the UK's tax system has been running on this idea of domicile. Basically, if your permanent home, the one you always go back to, was outside the UK, you could often dodge UK tax on your foreign income, unless, of course, you brought it into the country. This was known as the remittance basis. But this whole cornerstone principle, it's about to get a serious makeover.
It really is. It feels like the end of an era. We're moving towards a system that's all about residency, so it's not about this concept of where your forever home is anymore. Now the big question is, how long have you actually been living in the UK? Pretty major shift. Gov.uk even said it themselves late last year, basically saying this is the end of the line for that 200-year-old concept of domicile when it comes to taxes.
It is. And the government's saying it's all about fairness, trying to level the playing field. The idea is that if you're settling down in the UK long term, you should be chipping in to the tax pot on all your income, wherever it's from, just like folks who are considered UK domiciled.
And the numbers tell an interesting story too, right? HMRC's data from 2022-23 showed something like 74,000 people claiming non-dom status. That's actually up from the year before. But here's the thing. As a group, they were paying proportionally less tax than those UK domiciled individuals. And the government's hoping these new rules will bring in a pretty hefty sum. They're projecting an extra £12.7 billion over the next 5 years. So who's going to feel the biggest pinch from these changes?
Well, HMRC reckons about 9,300 non-doms won't qualify for a new thing they're calling the 4-year Foreign Income and Gains Relief, or FIG relief for short. This is a big deal because it means they'll have to pay UK tax on all their income from day one of being a UK resident.
Huge difference from that old remittance basis, huh? Under those rules, you generally only started getting hit with UK tax on foreign income if you brought more than £2,000 of it into the UK. Or if you decided to stick with the remittance basis for a long time, you'd eventually start paying a yearly charge.
Exactly. But now, for those who don't tick the boxes for this FIG relief, every bit of their foreign income is fair game for UK tax. Let me give you an example. Imagine someone's got £100,000 in foreign dividends. Under the old system, if they kept that money offshore, they wouldn't pay a penny of UK income tax on it. But now, depending on their total income, they could be looking at a tax bill of something like £37,430 at the current higher rate of 45%, of course, after you factor in the personal allowance, which is £12,570, and it's frozen at that level until 2028.
That is a massive change in how much tax someone might have to pay. So let's break down this new residence beef system and this FIG relief a bit more. How will it actually work come April 6th, 2025?
The basic idea is that how much tax you owe now depends on how long you've been living in the UK, not where you're domiciled. So for people new to the UK who haven't been a UK resident for the past 10 tax years straight, there's this 4-year FIG relief. What this means is they get a full 100% relief on any foreign income and gains they make in those first 4 tax years they're here, whether they bring that money into the UK or not.
All right, so that's like a grace period for people just setting up shop in the UK, which makes sense. But what happens after those 4 years are up? Or for those who've already been in the UK longer than that when these rules kick in?
After those 4 years, or if you've already been a UK resident for more than 4 years by April 6, 2025, your worldwide income and gains become taxable in the UK. HMRC data suggests the average non-dom individual makes between £50,000 and £100,000 in foreign income annually. Let's think about a business, for instance. Say a company employs a non-dom executive who earns, £80,000 in rental income from overseas properties. After the personal allowance, that could mean a UK tax bill of around £27,430 at the 40% tax rate. That's money that would have stayed out of the UK tax system before.
So full relief for new arrivals who qualify, but then the standard UK tax rules apply to all their income wherever it's from. Can we just sum up that FIG relief one more time just so everyone's clear?
Sure. For those who are eligible, meaning new arrivals who haven't been a UK resident for the past 10 years straight, they'll pay zero, absolutely no UK tax on their foreign income and gains during their first 4 years living in the UK, all thanks to the FIG relief. But from year 5 onwards, they're going to be taxed on all their income and gains at the usual UK income tax rates, which currently range from 20% to 45%.
Crystal clear. Now, what about those who are already claiming non-dom status and living in the UK before these new rules land? Are there any special arrangements to help them transition?
There are indeed. They've got some transitional measures in place for existing non-DOMs who don't qualify for that initial 4-year FI relief. Starting April 6th, 2025, they'll transition to being taxed on an arising basis. This means they'll be taxed on their worldwide income as it's earned, regardless of whether they bring it into the UK. However, just for the 2025-26 tax year, there's a special rule, so only be taxed on 50% of their foreign income for that year.
Sounds like a bit of breathing room to adjust, which is nice. Anything else in this transitional period to soften the blow?
They're also rolling out a temporary repatriation facility. It's a bit of a mouthful, but essentially it lets those who've used the remittance basis in the past bring previously untaxed foreign income and gains into the UK at a lower tax rate of 12%. This window's open for 2 years from April 6th, 2025, then it bumps up to 15% in the third year. And for capital gains tax, individuals can choose to rebase their assets to their value as of April 5th, 2019 for any disposals they make after April 6th, 2025. Could potentially shrink their capital gains tax bill.
So some definite perks to ease the shift for those already here. Let's move on to the impact on trusts, which I know is a biggie for many with international ties.
Right you are. Big changes afoot here. The trust protections that have always applied to foreign income and gains generated within non-UK trusts, those are going away after April 6, 2025. Meaning UK resident settlers of these trusts will now have to pay UK tax each year on all the foreign income and gains made within those trusts. This is a seismic shift, especially for those who've been UK residents for a while and have leaned on these trust structures for tax planning, asset protection, and passing things down the line.
Sounds like a radical departure from the way things were. Any exceptions to this new rule for trusts? Any loopholes?
Well, qualifying new residents, those who qualify for that 4-year FI relief we talked about, they won't be taxed on foreign income and gains within their offshore trusts during those first 4 years, as long as they claim the relief. But even during this time, they'll still be on the hook for UK tax on any UK income and gains coming from those trusts. And it's worth mentioning that figuring out how distributions from offshore trusts to UK resident beneficiaries are taxed is getting pretty complicated. And there's even the risk of what some might call double taxation in certain cases, particularly for those who are both the settler and a beneficiary of the trust.
Yikes. Sounds like you definitely need expert help to navigate that. Now, how about inheritance tax or IHT? What's the latest there with all these changes happening?
The government's been saying they're looking into aligning the IHT rules with this new residence-based system. What we know so far is that non-UK assets that have already been put into an excluded property trust, or EPT, before April 6, 2025, those will stay out of reach of UK IHT. But, as we've discussed, these changes to how income and gains within trusts are taxed are definitely going to make people rethink how they use and manage EPTs. Things get a bit trickier for trusts set up after April 6, 2025, and we're waiting on more details to clear things up.
What about being considered a long-term resident for IHT under these new rules? How does that work?
Well, under the new regime, you'll be labeled a long-term resident for IHT purposes if you've lived in the UK for at least 10 out of the past 20 tax years. Once you hit that mark, from your 11th year living in the UK onwards, all your assets, no matter where they are, become subject to UK IHT, even if you pack up and leave the UK. This creates something called an IHT tail, where folks who were once long-term residents could still be hit with UK IHT on their entire estate for several years after they've moved away. The exact length of time depends on your individual residency history. So let's say you lived in the UK for 15 years and then decided to move elsewhere. You'd still be considered a long-term resident for IHT purposes for a good few years after you've left.
Wow, that could have some serious consequences for people planning where they want to live long-term and how they want to handle their estate planning. Let's switch gears to Overseas Workday Relief, or OWR. How is that being affected?
OWR is also getting a bit of a revamp. For employees who arrived in the UK before April 6, 2025 and meet the requirements, they can still claim it for their first 3 years of being a UK taxpayer. And a big change is that they'll be allowed to bring those earnings back to the UK without any restrictions. However, chances are anyone new coming in from the 2025-26 tax year onwards who doesn't qualify for this new FGAR regime we've been talking about probably won't be eligible for OWR either. From April 6, 2025, OWR will be stretched out to 4 years, matching the FI relief, but with a cap on how much relief you can get. It'll be limited to whichever is lower, £300,000 or 30% of your total employment income.
Ah, so some tweaks there too. A big question that's likely on everyone's mind is how all these changes might affect how attractive the UK is to global talent and those high net worth investors.
That's a really crucial point. Lately, we've seen other countries, places like Italy and Portugal, offering some pretty tempting tax schemes that can last for 10 years or even longer. The UK's new 4-year FI relief, along with these changes to how trusts are taxed, could definitely sway how those ultra-wealthy individuals view the UK as a place to live. It really makes you wonder if these changes might make the UK less competitive compared to places that offer longer periods of sweet tax deals. For instance, Italy's got this flat tax regime for new wealthy residents, and Portugal's non-habitual resident scheme has been a hit because it offers a 10-year tax holiday on certain foreign income. These longer time frames could be a real deciding factor.
And of course, let's not forget we've got a general election coming up before January 31st, 2025. You never know what tax policy changes a new government might bring, so that's something to keep an eye on. Plus, there have been some reports in the news about how these new rules might be pushing some big names to make some big decisions.
Yeah, you're right. There's been talk about Lakshmi Mittal, the steel tycoon, thinking about moving out of the UK partly because of these new tax regulations. And if more and more wealthy individuals start to follow suit, it could mean a shift towards jurisdictions that are more tax-friendly, like the UAE, Italy, or Switzerland. Those who aren't so keen on these changes are worried that pushing wealthy residents away could actually hurt the UK economy in the long run. Because, let's face it, these are the folks who often contribute a lot through various taxes and charitable giving.
It's definitely a complex issue with potential ripple effects in many directions. So, to wrap things up, these are some seriously big changes to the UK tax system for non domiciled individuals. We're shifting from a domicile based system to one focused on residency, with a 4-year break for those who qualify as new arrivals and a bunch of transitional arrangements to help those already here. Anyone with foreign income and gains, along with those who've set up offshore trusts and have intricate estate plans, they're all going to feel the impact. Given how complicated these new rules are and how they could potentially shake things up for people's finances, it's a good idea for anyone who might be affected or thinks they might be to get some solid professional advice to figure out their specific obligations and what options they have. And on that note, a huge thanks to my tax accountant for setting up this important discussion. If any of our listeners need personalized help navigating these new tax rules, we strongly encourage you to reach out to the experts at My Tax Accountant. They can provide that tailored advice and help you make the right moves.